Good morning. My name is Joe Terril, president of Terril and Company, private wealth managers in St. Louis, Missouri, with approximately $700 million of discretionary assets under advisement. This is an update. I tend to think it's an important update that we're posting today, Thursday, August 25th. With the Federal Reserve, Janet Yellen giving an important speech tomorrow. It will lead us into talking about our outlook for interest rates, inflation, the economy, and markets. Brian Curtis, as always, our IT director here at Terril and Company, is helping us. And Brian, with that said, why don't we discuss very briefly our outlook for the economy, interest rates, and then we'll go on and later talk about the investment markets. The most important scenario that we can try and get across to our viewers, our clients, and people that we're involved with is we are at a point where we now believe interest rates around the world have bottomed. Interest rates are slowly going to begin to go up around the world, and they're definitely going to go up in the United States. Janet Yellen gives a speech that the media would make you think is life or death tomorrow morning at Jackson Hole, Wyoming, but I really don't believe that it will end up being that important what she says. The Fed's hand is going to be forced sometime in the next 18 months for them to raise interest rates. We project from this 0.5% level to perhaps as high as 2.5% over the next couple of years. The reason for that being will be strong economy around the world. Europe is doing better than people think. It's definitely doing better than the media would have you believe. Great Britain, after Brexit, is not falling apart. They're doing fine. China and Japan are showing some signs of doing better. So we look overall for a much stronger economy around the world, particularly even here in the United States. Housing is doing really well. Unemployment is falling. Average hourly earnings are going up. The consumer is in its best financial shape it's been in a long time. Auto sales are not going off a cliff. We look for GDP growth in the United States to go from something around the 2% level that it's at right now to perhaps 3.5% growth as we enter into the second half of the year. One of the negatives to this positive news is inflation that has been very calm up to this point is beginning to pick up and will continue to pick up. The growth between Federal Reserve Bank adjusted credit and the growth of M2 money supply has been a disparity. M2 money supply growth is finally beginning to pick up, has picked up over the last few months. Said in simple English, what this means is a lot of the money that the Federal Reserve Bank and central bankers all over the world printed in the last 6 to 7 years is finally beginning to enter the economy. Loan demand is strong enough now that banks are drawing down that money off Federal Reserve Bank balance sheets and they're loaning it out into the economy. This is inflationary. We look for inflation to pick up to a 3.5% to maybe as high as a 4% level in the next couple of years. This will force the Fed to raise interest rates whether they think it's a good idea or not. We think the Fed is going to raise interest rates at their September meeting, probably again in December. So trying to sum some of this up, the economies around the world are going to do fine. We're not getting ready to enter a recession and have any number of economic problems. That's not on the table. Good, strong economic growth is. But that also will mean higher interest rates, higher inflation. So with that said, Brian, let's perhaps stop and we'll go on now to what I think will happen with the investment markets. In the next 12 to 18 months, we believe investment markets are going to struggle. Bonds that have had a spectacular run over the last 33 years are going to perform very poorly. We need to be very careful about not being exposed to higher interest rates. We need floating rate paper, we need very short-term maturities, we need things in the portfolio that will benefit from higher interest rates. We think bank stocks are still a great investment. They'll benefit from the stronger economy, they'll benefit from higher inflation, and they definitely will benefit from higher interest rates. We still like the energy partnerships. Our prediction on oil is closer to $60 a barrel by the end of the year, perhaps next spring, than the current $47 a barrel. Some of these things may require further explanations. We're trying to touch on the major points with this video update. If you'd like further information of why we feel this way, or you want to see some of the statistics, you want to see some of the charts, please call us, email us, contact us, and we'll be happy to elaborate further. But we think the stock market that's selling perhaps at 17 and a half times earnings, even in a strong economy, when interest rates begin to move up, when inflation begins to move up, that price earnings multiple is going to fall back closer to 15 times earnings, which means we'll have a pretty reasonable correction in the stock market. The bond market is a bubble. The bond market, when central bankers in Europe stop buying bonds, quantitative easing in the United States is over, as interest rates begin to go higher, bonds and bond funds will suffer. This includes things like utility stocks and some of the investments that people have bought recently strictly for the dividends will be poor performers going forward because we're going to see the higher interest rates. So we are not negative about the economy, let me reiterate that, but we are negative about investment markets because of what we see. A strong economy and higher inflation will trim back the multiple at which stocks can sell at. We'll throw into the mix the wild card over the election. We'll throw into the mix that comes September and October. It's the end of the mutual fund selling season for their fiscal years. We could see a decent amount of tax loss selling by mutual funds. So Brian, let's leave it there. We'll be back with an update, but I just want to reiterate, strong economy, higher interest rates, higher inflation, but yet poor performing investment markets. That's our outlook. Thank you for joining us this morning on our update. Once again, my name is Joe Terril, president of Terril & Company, private wealth managers in St. Louis, Missouri. Brian Curtis, I thank you for your work in helping us, and we'll be back as needed or soon with further updates.